Hello. We're going to take a look at chapter 20 today, which is earnings per share. We're going to look at earnings per share, diluted earnings per share, and also what's called weighted average, which is our denominator when we're calculating earnings per share. We'll look at a basic earnings per share calculation, which you would have done back in 2020, but also a diluted earnings per share, which is considered a complex capital structure. So let's take a look at these PowerPoints, and we'll get through here as quickly as possible, and then we'll take a look at the homework. Okay, chapter 20, earnings per share, and this is the Pearson PowerPoint. So we're going to look at basic earnings per share, diluted earnings per share, also a topic here called anti-dilutive securities. And what do we do when the diluted earnings per share is anti-dilutive? And of course, disclosures. I'm going to go over here to the smart pad. Let me just do that here quickly and sort of give you an overview. We're looking at this chapter on earnings per share. You know, we have basic earnings per share. Remember that from 2020, where we have net income minus preferred dividends divided by common shares outstanding. We talked a little bit about that back in the equity chapter as well. But we're also going to look at diluted earnings per share. When we say diluted earnings per share, think of it in terms of what happens when you put antifreeze in your car. You know, you're supposed to water that down 50-50. If you don't know that, then you do now. You put 50% water with 50% antifreeze, and in effect, you are diluting that antifreeze. Well, in a sense, that's what you're doing here with earnings per share. Earnings per share being your net income divided by common shares outstanding, what the economy revolves around here in the United States, since it drives our stock market. But diluted earnings per share says if I've got convertible securities, and convertible securities being preferred stock or bonds, and also stock options. Those are the three primary areas that we'll look at in this chapter. Each of those securities, if they can be converted into common shares, then this is not that they were converted, but this is a what if scenario. If these securities could have been converted, what does that do to your what does that do to your earnings per share? And so that's what diluted earnings per share does. The calculation here is you're really expanding on this basic earnings per share. So if you got convertible preferred stock, in essence, you're going to add back that preferred dividend, and your common shares outstanding, you're going to add to that the number of shares that preferred can be converted to common. And the purpose of that, based on the conservatism principle, is this should have a dilutive effect. So if my basic earnings per share was $1 here, most times, but not always, most times this diluted earnings per share will make this earnings per share less than $1. Maybe 90 cents, maybe 80 cents, whatever it might be. We also have bonds that can be converted potentially, and if we have bonds that can be converted, we have to calculate the interest expense net of tax, and what does that do to our numerator, as well as what does it do to our denominator. And then the third area that we'll look at are stock options and the impact that will have on just the denominator, because when you have stock options that are being converted, there is no impact to your numerator. It's only a denominator. So you know that Based on that, your stock options are going to be the most dilutive of all of your securities that you have. All right, so that's most of this chapter. The only other part of this chapter is this new concept called weighted average number of common shares. You know, back in 2020, you may have been given in those exercises the actual average number of common shares outstanding for the year, or at worst, you were probably giving the balance sheet at the beginning of the year and the balance sheet at the end of the year. What is your common shares outstanding? You would just add those two together and divide by 2 for an average for the year. Here, we are looking at a weighted average based on every month. So you, in essence, have 12 months that you are averaging together. Now, it's not as simple as just taking January through December, add those 12 numbers together and divide by 2. That's okay to do that unless you have a stock split or a stock dividend. In that case, you have to go retroactively to the beginning of the year and make whatever shares outstanding, that particular, if it's a 2-for-1, doubling of your shares at the beginning of the year for the full year. It's retroactive, doesn't matter when it occurs. It's January 5th or December 31. It's retroactive to the beginning of the year. You remember when I've talked about Google before, and and when they had their 2-for-1 stock split, when their stock price got up to $1,400, if you go back and look on one of these financial websites like Yahoo or whatever it might be, if you look at a chart there of Google shares, even though it went public at $100 a share back in August of 2004, if you go back and look at the chart, it shows that stock at $50 a share. Well, it never traded for $50 a share. They retroactively went back and changed all those charts or changed all those numbers to where your charts are accurate. So it is an apples to apples. You know, on stock splits, you don't have to make any journal entries. Stock dividends is another matter, but whether it's a stock split or a stock dividend, those are retroactive to the beginning of the year. And I would argue back even further than that if you're doing comparative statements or comparative statements. All right, so that's kind of a brief overview. Let me go back here to the PowerPoint. Pull that back up and let's just go through these. All right, so now we're back to basic earnings per share. And I've already touched on this very briefly. Basic earnings per share, you remember from 2020 that you have the numerator is the top part, right? Numerator is your net income available to common shareholders. That's why you subtract out preferred dividends. All this is based on common shares. That's the ownership in the company, the true stakeholders or stockholders. So that's why you subtract out preferred dividends from the top, and it's divided by common shares outstanding. Preferred shares have nothing to do with this. So our calculation there again, basic earnings per share, net income available to common shareholders divided by weighted average number of common shares outstanding. Earnings per share, very important. Earnings per share provides a snapshot of the performance of the firm in terms of each share of stock investors own. And that's what drives our stock market, because a higher earnings per share drives a lower price earnings multiple. And that will drive more demand for the stock, in theory. So here's an example. Storage Corporation at $170,000 net income declared 10,000 preferred dividends, began the year with 15,000 common shares. They issued 7,500 and 9,000 on May 1 and October 1 respectively. So what does this look like? All right, so first of all, let's do our denominator, right? We start out with 15,000 shares for 12 months. So that's 15,000 for the whole year. You issue 7,500 on May 1. So you had 8/12, you had 8 months that you have 7,500 shares issued or sold. There's 5,000. Then we had this stock buyback, treasury stock purchase, 1,500 shares. So that's reducing, you remember from back in the chapter on equity, that's reducing our common shares outstanding. All right, that's one of the reasons why companies buy their stock back. It's going to boost their earnings per share. Even when sales revenue stays the same and expenses stay the same. So we have 6/12, since that's July 1, we have 6/12 of a negative amount, right? So that's 750. And then finally, we issued 9,000 shares on October 1, so you had 3/12. All right, so we just add all that up, and that gives us our weighted average number of shares. So that's what we use for our denominator in calculating earnings per share. Now, if you were to look at your balance sheet and your year-end statements for December 31, 30,000 is what's going to be on there as shares outstanding. You know, it has the authorized, it's got the issued, it's got the outstanding. The outstanding is going to be 30,000. What would your issued be? Well, it would be 30,000 plus the 1,500, right? 31,500. We don't know what the authorized is. That's kind of beyond the scope of this, but it's good to go back and tie this into what we've already learned in the other chapter. All right. That's weird. Way you put those, if you can see those blue markings on there, it's supposed to be on the prior page. It'll go away on the next one. All right, so stock splits and stock dividends, like I just pointed out. The assumption is it's beginning of the year. Doesn't matter when it occurs. If it's January 15th or December 3rd in the year, it's retroactive to beginning of the year. Retroactive. That's what's going to make that exercise a little more complicated if, in fact, we had a stock split thrown into this. So here is an example. There's a 2-for-1 stock split on July 1. Right halfway through. You began the year at 15,000, issue another 7,500 on May 1, and 1,500 shares on November 1, which is after the stock split, right? What does that look like? I like the way they do this. It's probably the most simple way to explain this. So down the left side again, this is what's going to be on your balance sheet at year end. Outstanding. But for calculating earnings per share, we're going to do this over here. All right, so we had 15,000 shares beginning of the year. So for the full year, 15,000. We issued 7,500 on May 1. So 8/12, 8 months of that is 5,000. So we got 20,000 shares, weighted average, before this 2-for-1 stock split. And so it doesn't matter if this has been May 2nd or July 15th or even October, you're going to multiply that number by 2 to get 40,000. It's retroactive to the beginning of the year. And then finally, we issued 1,500 more shares after the stock split. All right, so if that's after the stock split, these aren't going to be doubled. It's after the split. All right, so 2/12, which is November and December. All right, 2/12 of that 1,500 is 250, so that gives us, we add the 40 and the 250, that gives us 40,250 shares. Good point here about managing earnings. I know we're talking about this in our controllership class in the MAC program right now, about managers being incentivized to manage earnings per share to meet analyst forecasts. Managing earnings, something that controllers have pressure put on them to do, to try to have a smoothing of earnings to where earnings per share goes up a little bit each quarter and each year instead of this zigzag that sometimes will happen. But we have to follow GAAP. We have to follow what FASB tells us to do in the process. So we have to be careful about doing things with earnings per share. Because, again, bonus plans, as we just talked about in one of the other chapters, I guess it was the last chapter, I believe. Bonus plans, right? Stock appreciation plans, remember that? Restricted stock, of course, restricted stock, maybe not as much, but stock appreciation plans or stock options, the exercise price and so forth. Have to make sure that they're driving the right behavior. Not a good summary of judgments, going back through all the different chapters we've looked at, going back to chapter 8, issues related to revenue recognition. Chapter 9, bad debt expense, allowance for bad debts. What about Chapter 10, measurement of inventory? What about net realizable value? Chapter 11, initial measurement of property, plant, and equipment. Chapter 12, we talked about impairments, right? There's judgments involved there. What about the ARO, Chapter 13, asset retirement obligations, your liability. And if it's a liability, set up on your books, recognition, measurement of contingencies in Chapter 13. I don't think we talked about bifurcation of debt and equity components of hybrid securities. Skip that. Classification of investments, Chapter 16. Measurements of impairments of investments. Those unrealized gains and losses. All the judgment calls that you have to make as an accountant, really as a controller as you move up in the organization. Look at Chapter 17. The valuation allowance. Remember that from the income tax chapter on the last exam? Tax contingency. It's because you deduct it with the IRS. Is it more likely than not, greater than 50%, that deduction is going to stand? And if not, you need to set up a tax contingency, which gets what? That's a credit to liability. The debit is where? To expense. So you've got to be careful about manipulating your books with those expenses and accruals, or not accruing, to make your earnings per share, right, your net income, look better than it is, or worse than it is. It goes both ways. If you have a great year and then you start trying to look for stuff to accrue, you got to be careful about that. I've seen that happen a lot. Pressure to, you have a good year, go ahead and accrue some expense that the obligation has not occurred. What about lease types? We just looked at in Chapter 18. Operating versus capital. They've changed a lot of that though, right? Now it's about everything. If it's more than a year, it's going to be a capital lease, asset, liability on your books. And Chapter 19, we looked at what? The measurement of stock-based compensation. There, is that driving the right behavior? You should have a long service period, and not just a 1 year. If the stock goes from here to here in 1 year, or from here to here in 1 year, that you don't reward the key drivers, the key people for that performance. It should be a performance over several years. All right, that's a good slide there. Slide number 20-17. So now we're going to jump into diluted earnings per share. So we always start with basic earnings per share. And again, basic earnings per share is a simple capital structure. Diluted earnings per share is for a complex capital structure. And there it says that, right? What simple is and what complex is. You can read that on your own. But all this for diluted earnings per share is a if converted. This isn't what did you do. This is a what if. If you've got convertible preferred stock, if you've got convertible bonds, and they're convertible into what? Common shares of stock. Or if you have stock options, which if those are exercised, if they're in the money, right, the market price is above the strike price or the exercise price, then you have something there that needs to be calculated as diluting your earnings per share. And again, stock options always dilute earnings per share because there is no change to the numerator. See, with bonds and with preferred stock, there's always a change to the numerator, be it the preferred dividends are no longer paid out or the interest expense is no longer paid out, depending on whether it's preferred stock or bonds. Convertible debt, diluted earnings per share numerator. So you're going to avoid, if it's converted into shares of common stock, you're going to avoid the interest expense on this convertible debt, right? Yes, and that's going to be generally tax deductible, so you have to do a 1 minus the tax rate. All right, 1 minus the tax rate. The tax rate's 40%. 1 minus 40% is what? 0.60. So 0.60 times your interest expense tells you how much needs to be added back to your numerator. And then whatever number of shares or however many of those bonds, what the ratio of conversion is from the bonds to the common shares is what you're going to add to the denominator. So in essence, you are adding back to your numerator because your interest expense is no longer being paid. So your numerator is going up from the interest expense no longer paid, net of taxes, right, the 60%, but your denominator is going up as well. So they're both going up. And then the question is it dilutive or is it anti-dilutive? Meaning it makes the earnings per share go up, which you don't want because that goes against the conservatism principle. Okay, so here we've got Cincinnati Crafters for $100,000 in interest expense for convertible bonds, 40% tax rate. There were no actual conversions during the year. What adjustments needed to the company's diluted earnings per share? Well, the interest expense is $100,000. The tax would be what, $40,000? So $60,000, or 1 minus the tax rate times your interest, same thing. $60,000 is going to be added back to my numerator. I'm no longer paying that out. That's going into net income. They make a point here that things don't always show up on January 1, meaning the assumption so far is it's a full year. But what if it's mid-year? What if you issue the debt mid-year? Then you're looking at what? One half of the interest expense and one half of the denominator, the number of bonds that are converted into shares of stock. It's no big deal. You're just going to prorate for the year. Don't make that more difficult than it is. All right, there's diluted earnings per share for both preferred and for bonds. All right, so there's bonds, and this is for preferred stock. And you can have both of these going on at the same time. In fact, you very likely would. So the formula there, that we've taken the basic earnings per share and expanded. You're using the same formula, the same format, same structure. So net income, it says available to common shareholders, but it's net income is what it is. You're going to add back the interest expense at 1 minus the tax rate, divided by a weighted average number of shares, which we just looked at. And then for diluted earnings per share for preferred stock, those preferred dividend requirements, well, they're not doing preferred stock here. They're just saying, what if you had preferred dividends on your preferred stock? This is all about bonds, looks like. If you had preferred stock as well that maybe is not convertible, you're still subtracting preferred dividends out, but you're adding back the interest expense. All right, so they're going to break this out to 2 different sections as far as bonds, as far as preferred stock. But again, if this had been, I'll just go ahead and write on here. What if you had diluted earnings per share for preferred stock? Go ahead and do it myself. Net income divided by weighted average number of common shares outstanding plus common shares on preferred stock conversion. See, you don't subtract preferred dividends because you don't have any preferred dividends anymore. If it had been converted, again, this is all what if. What if? Not what did you do, what if? And you can say mine's preferred dividends, but you're going to add back the preferred dividends because the net's zero. That has everything on it except for stock options. Okay, so here's convertible debt. Again, talking about bonds. Could be notes payable as well, but we'll just stick with bonds. And what we talk about here, 800,000 common shares outstanding, issued 300,000 more on September 1. So we need to do weighted average number of shares. They don't have any stock splits or stock dividends on here, mixing it up with the same thing. Trying to keep it simple because they're trying to focus here on the actual dilution. And so they also have 2.3 million par value non-convertible. If it's non-convertible, there's no what if scenario. It's only if it's convertible, preferred stock. We're still going to have to calculate the interest expense, aren't we? Or excuse me, the preferred dividends, which is 3% times 2.3 million. 2300 times 0.03, $69,000 preferred dividends. In addition, the firm has 20 million, 5% convertible bonds. So they are, what if, convertible bonds for a full year. 5%, what is that, $1 million? There it is. I didn't have to calculate. $1 million of interest expense for the year, 5% of that. The bonds are convertible into 450,000. So that's what's going to change on your denominator. We're going to add 450,000 shares to your denominator. And that $1 million times 1 minus the tax rate, which is 0.4. So that's 0.6. That's $600,000 that we're going to add to the denominator, or excuse me, the numerator. So like math class again from high school, doesn't it? The numerator. There's the net income of $7 million. Let's see what that looks like. Maybe. Screen went dead on me. All right, so there's my net income, $7 million minus what? That's $69,000 we just calculated. So there's my numerator. 6931, 7 million minus the 69. Net income minus preferred dividends divided by weighted average shares. So what's my weighted average? I started at 800,000 for 12 months. Then I issued 300,000 on September 1. So there's 4 months left in the year, September, October, November, December. So there's my denominator for basic earnings per share. Again, that's what's on the balance sheet, that 1.1 million, but this is what you use for your earnings per share calculation. So my basic earnings per share that we always want to start with, 6.931 million divided by 900, that's my basic earnings per share. All right, we've already calculated the after-tax interest savings, or after-tax interest savings, right? So we're going to add back 600,000 to my net income. There it is, 6931. You're still subtracting preferred dividends because it's not convertible. So you still subtract that out. There's my 600,000 interest expense. 900,000, there's the 450 is the common shares added from the conversion. The what if I converted? So there's my diluted earnings per share, 550. So that is less than 770. So conservatism principle says use diluted earnings per share because it's less. You don't want to mislead investors. This is convertible debt issued during the year. Again, I'm not going to spend time on this because it's just a fractional amount for your denominator and your numerator, as we saw in that other example there of 50%. So let's keep going here to convertible preferred stock. So this is part 2. We got interest expense from bonds payable or notes payable. Now we're going to look at preferred stock, and then we'll end this discussion with what do we do with stock options, which is a little bit unique. All right, so my numerator here, dividends are what? They are not tax deductible. So many people make that mistake on exams. They're not tax deductible. So don't think I've got to do 1 minus the tax rate times my preferred dividends. You don't. Remember, what did you do with dividends? What happens when you declare, when the board of directors declares dividends? You debit retained earnings, or dividends common, and credit dividends payable, right? Has nothing to do with expense. There's no such thing as dividend expense. And so many people put that on the exam, prior exams, as dividend. There is no such thing as dividend expense. You're reducing retained earnings and increasing your liability. And then when you pay it, the liability is wiped out and it comes out of cash. Anything you got to have for dividends, whether it's common dividends or preferred dividends, you got to have cash and you got to have retained earnings. By and large, there are exceptions, but there is no such thing as dividend expense. So that's why don't multiply preferred dividends times 1 minus the tax rate. That's wrong. So in a sense, preferred stock that's convertible is the easiest of all of these. All you have to do is say, well, I no longer pay my preferred dividends, and I'm just interested in what? Adding to my denominator, what the number of shares of conversion from preferred to common. And so here's an example of Hammond Aeronautics has 400,000 shares of common, 150,000 shares of non-cumulative convertible, keyword there, convertible preferred stock. Paid 100,000 in dividends. Preferred stock is convertible into common stock at a rate of 1 share of preferred for each share of common. So that's going to be what? An extra 150,000 shares on my denominator. All right, so the 700,000 minus 100,000, this is basic. You're not doing any of this what if. Basic earnings per share, $1.50. And so to calculate diluted, we're not going to deduct that, are we? But we're going to add, what was the amount? 150,000 shares to get diluted earnings per share. So 700,000 divided by 550 looks like $1.27. Which is less. It is diluted, isn't it? There it is. Very simple. Preferred stock's probably the easiest. But remember, there's no such thing as the tax effect of preferred dividends. All you have to do is just don't deduct preferred dividends on the diluted earnings per share. They're showing that you're subtracting and adding it back, that's fine, but what is that? That's zero, isn't it? You just don't subtract it for diluted earnings per share. All right, so that leads us to the final part of this lecture here on the primary parts, the intermediate parts of Chapter 20 with options and warrants. I don't care about warrants as much as options. Options are much more common. And remember, with options, all you are doing is impacting the denominator. There is no impact in the numerator for options. It's only denominator. So that tells you options are always dilutive. Preferred stock and bonds, the notes payable, conceivably those could be what? Those could be anti-dilutive. The increase in common shares outstanding due to the assumed option warrant exercise of in-the-money instruments. Remember that last chapter we looked at, talked about the exercise price or the strike price, that let's say the strike price is $5 per share. And in the money says that the market price, this is the strike or exercise price. If you got stock selling for $10 a share in the market, then what? This is in the money. Like that term? In the money. Meaning these officers that have these and they're past the service period, if they have the opportunity to exercise this, and they would if it's between there, or any amount that's greater than 5, it's in the money if it's above the strike price. And that's the assumption here, is we're going to do this calculation. But remember, there's always cash proceeds the company receives from the assumed exercise. Remember the debit to cash we had for those options? They pay for the options at $5 a piece. And they're gladly paid $5 a piece if they can turn around and exercise this and sell the stock for $6 a piece, right? Or 10 or 100 or whatever it might be. So that's in the money. That's the key phrase there. I don't think they used that back in the other chapter. And we use what's called the treasury stock method. This assumes that if you are getting that much cash for these options, If you're going to go out and buy these shares, how many shares is that? And the difference between those number of shares and the number of options that are out there tells you how many shares you would have to go out and actually buy, which is going to be your incremental amount of shares on your denominator. Now, having said what I just said, let's just look at the example of these incremental shares. How do we calculate that? Here we got Edwards Group's current year net income is $9 million. The company reported $5.4 million common shares outstanding for the year and an average price per common share of $72. So that's the average market price, $72. Right? The exercise price is $54. And they got 1.8 million options, don't they? 1.8 million. So 1.8 million, I can probably just turn the page and let it show me what the numbers are. But the exercise price is 54. This is the amount of cash that's coming in. 1.8000000000000. $1.8 million times $54. So I'm going to get 97 million. And this isn't what was exercised. This, because if they were exercised, it'd already be in your common shares outstanding. This is what if all of these options were exercised. All right, so if they had been exercised, I've got $97,200,000 of cash coming in. I didn't get this, it's this what if. And so 97,200,000, how many shares can I buy or could I have bought on the open market at $72? Right? If that's the average price, 72, then that tells me I could have bought 1,350,000 shares. All right, but how many shares, how many options and shares are there? 1.8. So 1,350 from 1.8 is 450,000 shares. So that's what I'm going to add to my denominator. That's denominator, not denim. First, I do basic, which you should always do basic earnings per share. There's my 9 million divided by the 54,000. Basic earnings per share, $1.67. So now let's do diluted earnings per share. And there's the calculation I just wrote on the screen. You got 1.8 million times $54. That's the cash coming in, the proceeds. That's the cash that would have, not that it came in, that's what would have come in. 97,200,000. And if the market price, remember, when you're buying your own share, this is why it's called the treasury stock method or the corporate buyback method. If I'm going to go out and buy this, I'm going to have to pay what everybody else does, $72 a share. So that says that I would have purchased 1,350,000 shares for these options. All right, and if 1.8 million is what's being exercised, then 450,000 is what I need to add to my denominator. 450,000. There it is. 9 million. There was no preferred dividends. It's irrelevant here. Bonds, interest, irrelevant. So there I'm adding my 450,000. So that's dilutive. It's always, stock options, always dilutive. The other may be anti-dilutive. Earnings per share could go up, and if the earnings per share goes up, you should ignore it. All right, good little chart there. Convertible debt, add back after-tax interest expense, after tax, add back preferred dividends on convertible preferred stock. There's no tax impact there. There are no numerator effects for options. And what do you do on the denominator? You're just adding the additional weighted shares, whether it's a full year or 6 months or 4 months, whatever, to your denominator. Offers, we'll just skip through this. What about anti-dilutive? I've been talking about that up till now. That's when the basic earnings per share is lower than diluted earnings per share. Meaning your diluted earnings per share goes up, which is impossible for options, but it is possible for bonds or for preferred stock. And if it is anti-diluted, you would ignore that. That would be a good test question, wouldn't it? If I could put that on the test, online exam. All right, so here we've got 400,000 shares of common, 150,000 shares of convertible preferred stock. Declared 100,000 in dividends on the preferred shares, net income for the year 700,000. Preferred stock is convertible at a rate of 1 common share for 3 of preferred. Are the convertible preferred shares dilutive? Well, there's your basic earnings per share. Always need to do that first. And then diluted earnings per share. And that indicates it would be what? That $100,000 added back into 50,000 common shares, that's $2. Well, that's higher than $1.50, so you know it's anti-dilutive. We've already looked at that. A key part of this chapter as well, and one of the last things, is anti-dilution sequencing. You know, when we're looking at these individually, because we've looked at an example for bonds, we looked at an example for preferred stock, we looked at stock options. Well, what if you got all three going on, which typically is what happens? You are actually doing a calculation for each of those independently of the others. Kind of like what we just looked at, that one for preferred stock. So we need to do this separately. There's a good exercise in Pearson that will work here shortly. I don't believe they go into the detail here. They do not. All right, the final section here is on earnings per share disclosures. A lot of stuff has to be disclosed. Extraordinary is no longer, and I believe they may have taken that out. Extraordinary earnings per share or extraordinary items is no longer relevant. Let's see it on there. What is important is this continuing versus discontinued operations for both. There's an exercise in Pearson that goes through this, does a good job, both in total dollars and in earnings per share. So I think I am through with the lecture part of this chapter. You do need to know how to calculate price earnings ratio. And we just learned how to do earnings per share, but price earnings ratio, and it's really very simple. What you're doing there is, and there's space to do that, PE, or price earnings multiple, is nothing more than the market price of stock divided by your earnings per share. That's your multiple. Whether it's basic or diluted, you can have a PE for both of those. But that's very, very straightforward. So you should be able to do that on exam. I don't know if you need really an exercise for that, but PE ratios are very common. Okay, so that is chapter 20, earnings per share, diluted earnings per share, weighted average common shares outstanding, 3 basic topics. We'll look at the exercises in Pearson on a future video.